The United States and the world economy collectively had a difficult time in the early 2020s. The US started with the COVID-19 pandemic, which disrupted global supply networks and resulted in a brief but terrible recession. Then, when the economy began to recover, increasing spending drove inflation to levels that had not been seen in decades. The Federal Reserve reacted by announcing a plan to boost interest rates and rein in inflation. Rather than assuaging investors, the statement created a fresh cause of concern. They were concerned that the Fed's activities might lead to another recession in the United States. Google searches for recession almost quintupled between March and May 2022. However, analysts disagree on whether the United States should anticipate a recession in 2022. They agree on the current state of the economy in the United States, but they differ on what it means for the future. Hello and welcome to today's video. Today we will talk about the recession. What signs might you want to keep a keen eye on that indicate a possible recession? Before we look at these, please like, subscribe, and turn on the post notification bell. Let's get started. 10. Factories become quieter. While the United States does not produce as much as it once did, the health of the country's manufacturers is still a solid indication of the economy's overall health. Every month, the Institute for Supply Management conducts a poll of manufacturers to determine how busy they are. The replies are gathered into a number, which is referred to as an index. It's also a flashing warning light. Manufacturing in the United States is rising when the index is over 50. When it dips below 50, it indicates a decrease in industrial activity. The index dropped to 47.8 in August 2021 and struggles to go up again, the lowest level in 10 years. A sharp decline indicates that the economy is in peril, and a value of less than 45 usually indicates a recession. 9. Interest rates get weird. When the yields or interest rates on U.S. Treasury securities begin to behave strangely, it's another sign that a recession is on the way. Because you should earn a greater return for putting your money up for a longer length of time, a 10-year Treasury note should pay more interest than a 3-month Treasury bill or a 2-year Treasury note. However, in what is known as an inverted yield curve, long-term rates were recently lower than short-term yields. It's an indication that investors are losing faith in the future. For the first time since the financial crisis in 2007, the 10-year yield fell below the 2-year rate. Over 50 years, Treasury bond rates have gone haywire ahead of every recession. 8. High inflation. Inflation is not an indicator of a recession itself. In reality, inflation is at its peak during times of rapid economic expansion. However, because of the way the government reacts to rising inflation, recessions often follow. Central banks, such as the Federal Reserve, boost interest rates when inflation is strong. As a result, customers are more likely to spend less, lowering costs. However, it is too easy for a central bank to overreach and cut expenditures too much, causing the economy to enter a recession. Inflation in the United States was abnormally high in 2021 and still in 2022. The inflation rate peaked at 8.5% in March 2022, the highest in almost 40 years. The Federal Reserve retaliated by announcing a series of interest rate rises in 2022. Many analysts believe that the United States will enter a recession due to this. In a CNBC poll conducted in May 2022, 57% of experts predicted a slowdown due to the Fed's rate rises. They did not, however, believe that the recession would begin in 2022. The average commencement date they forecast was August 2023. Number 7. Low business confidence. Consumer spending is just a small component of the economy in the United States. Business spending is also significant. Business owners are less inclined to recruit staff or invest in production when they are worried about the future. And they're worried about it in 2022. According to the CNBC Small Business Survey, small company confidence was approaching an all-time low in April. The majority of small company owners rated the economy fair or poor. They were most concerned about inflation and supply chain disruptions, labor shortages, and the continuing epidemic. Over 80% said a recession in 2022 was highly probable or fairly likely. Larger companies are worried as well, although to a lesser extent. From October 2021 to April 2022, Moody's Business Confidence Indicator for the United States indicates a slight dip in confidence. It is, however, still higher above the historical norm. Number 6. Unemployment shoots higher. A sudden increase in the unemployment rate in the United States is an indication that a recession is on the way or has already begun. What do economists mean when they say rapid? They compare the current unemployment rate to the lowest rate in the previous 12 months. If they detect a 0.3 percentage point gap, there's a higher chance of a recession. When the difference exceeds half a percentage point, it signals the start of a recession. There hasn't been a problem here. The unemployment rate fell to 3.5% in September 2019, the lowest level in 50 years. Number 5. Car sales reduce. After their houses, most Americans' second biggest purchase is an automobile. You'll still need a vehicle to get about in the United States unless you can depend on public transportation or one of the ride-hailing services, Uber and Lyft. However, you are not required to purchase a new vehicle. People purchase more new automobiles when the economy is robust. When a recession is on the horizon, new automobile sales drop. Sales usually peak immediately before a slump, and then purchasers slow down. Over the previous decade, auto sales have been on the rise, but they have recently slowed. This might indicate that the economy will have difficulties in the future. Number 4. Home building cools off. Developers and contractors must get building permits before they may begin construction on new residences. Usually, they are obtained several weeks before the commencement of work. Building permit rates strongly predict the economy's health or weakness. However, this is not always the case. Permitting did not slow significantly before or even during the 2001 recession. For 2 reasons. Building permit data may not be useful in anticipating the next recession. To begin with, the building sector has yet to fully recover from the last crisis. Second, housing currently accounts for a lesser portion of the economy than it formerly did. Number 3. Low consumer confidence. The economy of the United States is based on consumer expenditure. Producing products and services is pointless if no one wants to purchase them. As a result, consumer confidence is a critical economic indicator. Consumers are less ready to spend when they are concerned about the economy. They save up money for a rainy day, which they anticipate. Unfortunately, when consumer spending falls, this anxiety may become a self-fulfilling prophecy, driving the economy into a recession. Consumer confidence surveys in 2022 are uneven. From December 2021 to May 2022, the University of Michigan survey of consumer sentiment dropped dramatically. However, according to the Conference Board's Consumer Confidence Index, individuals are still mainly optimistic about the economy. If Americans are concerned, it hasn't yet significantly impacted their spending. According to a McKinsey poll released in May 2022, Americans spent 18% more in March 2022 than they did 2 years before the epidemic. However, there are some early indications that expenditure is slowing. According to CNBC, Walmart, which caters to low-income customers, recorded a drop in sales in May 2022. Shoppers were purchasing fewer things and switching to store brands to save money. Number 2. Stocks go on a losing streak. Because the stock market is so unpredictable, it isn't necessarily a good predictor of a coming recession. Stock price reductions might be before price increases. However, continuous stock market losses might signal the start of a recession. A lengthy bear market, defined as a plunge of 20% or more in the stock market, would throw the economy into a free fall. Businesses are lowering their expectations, reducing employment, and tightening their belts. According to CNBC, a bear market severe enough to cause a recession lasts an average of 508 days. So far, there's nothing to be concerned about. Since early August 2021, the Dow Jones Industrial Average has steadily risen. Number 1. The timing just seems right for a recession. Over the summer, the current economic growth set a new record for the United States as the longest ever. Since June 2009, the economy has been expanding. That, however, will not persist indefinitely. The growth will sometimes run out of steam, and the economy will decline. That is a downturn. The cycle of expansion and contraction has occurred many times throughout history. So prepare yourselves, since the pattern implies a recession is coming. It may not be nearby, but you must take efforts to ensure you are ready when the time comes. Well, that marks the end of our video. Do you think a recession is on the way? How are you prepared to deal with it once it hits? Let us know in the comments. Like, subscribe, and share it to help your loved ones prepare if something comes up. Until the next one, stay safe.